Good day. This is the 18th video tutorial on Designer program. In today's lesson, we will continue to discuss the topic of arbitrage strategies and consider the pair trading strategy. We will build a strategy that will trade based on convergence and divergence of the index, which reflects the ratio of the value of one instrument to the value of another. We will take Cyberbank shares for the first instrument and Gazprom shares for the second. Since the cost of the first is higher than the cost of the second, the ratio will initially be greater than 1. Accordingly, initially we enter the market by selling a more expensive asset and buying a cheaper one. In our case, we buy Gazprom shares and sell Cyberbank shares. When the index tends to 1 or lower, the situation changes, as theoretically Gazprom grows and Cyberbank declines, and we sell Gazprom shares and buy Cyberbank shares. All this is done in order to reduce our losses, compensating for the decline in one asset by the growth of another. It may seem that this type of trading does not bring profit. At best, trading goes to zero. However, for short periods of time, this situation can instantly change, and sharp price surges can be profitable. In the manual trading mode, the trader is not able to catch the moment, but the robot reacts instantly, allowing the trader to make money on pair trading. We will take the strategy from the previous lesson as a basis, changing it. Since we are using the Gazprom shares instrument, we will replace the futures instrument with a new shares instrument. It must be remembered that you should have downloaded market data on both instruments, so that there are no problems with the strategy operation. So, as in the previous lesson, we have 2 instrument cubes and 2 candles cubes. Using the converter cube, we get the closing price from them and pass it to the variable cube. Initially, the variable cube does not contain any value, and only after receiving the closing price, the cube passes on a signal from the candles cube, the received value, to the formula cube. The formula cube calculates the ratio of the closing price of one instrument to the closing price of the second one. In our case, the formula cube calculates an index indicating the ratio of 2 prices. Since the lots of both instruments are roughly correlated in price and contain the same number of shares, we will change our formula. Variable B is the closing price of Cyberbank shares. Variable A is the closing price of Gazprom shares. Change the formula and write B/A. Let's set a link. Now the formula cube is a cube that calculates the index of 2 instruments. Let's remove the index cube from the previous strategy. We will not use it since it is calculated in the formula cube and there is no need to clutter up the schema. Remove unnecessary cubes and shift the schema a little for convenience. So, we've got the index of price ratio of 2 instruments, in our case, the higher price to the lower one. If the index starts to grow, then the Cyberbank shares value rises, and the Gazprom shares value falls. We sell more expensive Cyberbank shares and buy cheaper Gazprom shares. If the index starts to decrease, then the situation is reversed. In the previous lesson, by observing the chart, we determined the average index value. And based on this, the size of the index deviations from the average was assigned, thereby determining the strategy behavior. In this schema, we will automate the calculation of index average by taking the SMA indicator over 10 periods, and using the formula cubes, set the limit index values that determine the strategy behavior in the market. The condition will be as follows. If the current index value has deviated by 0.05 units from the average value in the direction of increase, then we buy Gazprom shares and sell Cyberbank shares, so Cyberbank shares grow while Gazprom is getting cheaper. If the current index value deviates from the average value by 0.05 units towards the decrease, then we sell Gazprom shares and buy Cyberbank shares, so Cyberbank is getting cheaper and Gazprom is growing. The strategy carries out pair trading, compensating for losses and making it possible to make money on instant jumps. To calculate the average index value over 10 periods, select the indicator cube. In the settings, specify the SMA indicator and set the number of periods equal to 10. This cube will now calculate the average index value over 10 periods. Connect the formula cube and the indicator cube. To store and pass the average value further along the schema, use the variable cube. It will receive and pass average value by signal from the indicator cube to determine the index change. Initially, it does not store any data, and only after receiving the value, it passes the average index value. The pass signal is sent to the indicator cube trigger. In order to set the upper and lower limits of the index limit value, use the formula cubes, in one of which the upper value will be calculated, in the other, the lower one. When the index of calculated limits is reached, the strategy will trade in a set direction. Remove unnecessary cubes. Select the formula cubes and write in them the formula for calculating the critical index values. In the first cube, we write down the formula that calculates the index value when the average value increases by 0.05. Here, A is the average index value over 10 periods. The letter M indicates the decimal value, writing as 0.05 M. The formula for calculating the lower limit is set similarly. With that, 0.05 is subtracted from the average index value. Connect the cubes. Now the formula cubes get the average index value and calculate the limit values. One cube calculates the upper index limit, and the second is the lower limit. Connect the formula cubes with the corresponding comparison cubes. Now we get if the current index value is greater than the deviation from the average value by 0.05, then strategy sells Cyberbank shares and buys Gazprom shares. Cyberbank grows and Gazprom falls. If the current index value is below the average by 0.05, then the situation is the opposite. We buy Cyberbank shares and sell Gazprom shares. As Gazprom is growing, Cyberbank is getting cheaper. Let's display a chart of the average index value for clarity using the chart panel cube. In the cube responsible for the order volume, change the quantity to 1, since the number of shares in both lots is the same. Let's run our strategy and see how trades are registered and a chart is plotted. It should be remembered that the market data for both instruments must be downloaded. As you can see, a chart of the average index value is plotted. Let's look at our orders. As can be seen, when the index exceeds the value specified in the strategy buys Gazprom shares to sell Cyberbank shares. As soon as the index value falls below the specified value, the trade changes, and the strategy starts buying Cyberbank shares and selling Gazprom shares. The fall in the index is clearly visible on the chart. Accordingly, a change in the strategy behavior is immediately noticeable. An important point in creating a strategy is to identify the dependence of the volume of one order in relation to another. This is necessary for trade compensation. Simply put, how many shares of one instrument are in one share of another instrument. Since the lots by the number of shares are equal in our case, the volume ratio will be equal to the index value. Taking the Cyberbank shares volume value per unit, we express the Gazprom shares volume via the formula, in which the volume will be equal to the Cyberbank shares volume multiplied by the index value. To do this, remove the cube responsible for the Gazprom shares volume. Select a formula cube. Write down the formula for calculating the volume in it. Since the Cyberbank instrument volume is equal to 1, in the formula we will write 1 multiplied by the index size. Connect the cubes. Let's start the strategy. As you can see, due to the non-integer value of the volume, errors occur when registering an order. For our example, we considered the basic principle of the volume dependence in order, not to overload the schema. To correct the error, assign the round operator in the formula cube, which is responsible for rounding. Since the volume is, in fact, equal to the index, we set the index value as the variable A, and as the variable B, the number of decimal places equal to 0. And run again. As you can see, Orders are registered in integers. This example is the simplest one. It is necessary to understand the dependency, as is given, in order not to complicate the schema. So, the essence of paired trading is to identify pairs of securities with a high degree of correlation, one of which has significantly increased or decreased in price relative to the other. Then we make a short sale of the overvalued, growing and buying an undervalued, falling security. Thus, a beta-neutral profile is created. Its profitability does not depend on the general direction of market movement and from the forthcoming ratio of the one security value to another, that is, in our case, from the change in the index of the two prices. This reduces possible losses and makes it possible to make money at the moment of price jump. With that, the strategy reacts instantly to changes, which makes it possible not to miss the favorable moment for trade, which can be impossible in manual control. That's all. Thanks. Goodbye.